RJ Baxter here, Fairway Independent Mortgage with your weekly market update. Let's break down the Fed meeting that happened this week with the Fed announcing on Wednesday that they're going to cut rates by another 0.25%. So the federal funds rate, which is the overnight bank rate that banks use to lend money to each other, is going to get down now to the 1.25 to 1.5 range. So I wanted to talk first of all about how this affects the mortgage markets specifically so that you can talk intelligently about this with your clients as you're out there showing homes if this topic comes up. So the first thing I wanted to remind you of, if you've seen some of my previous videos, some of my previous market updates, I've talked about this before, about how a Fed rate cut does not necessarily equal a mortgage rate cut. It's not the same thing. You're going to see articles out there on media with supposed economic experts talking about mortgage rates falling with the Fed rate cut, and nothing could be further from the truth. It's not a direct correlation, and a lot of the general population thinks that when the Fed cuts rates, it means mortgage rates go down. All you have to do is look back at what happened earlier this year with rates dropping dramatically from January through March earlier this year, and the Fed did absolutely nothing during that time. There was no Fed rate cuts, no Fed rate hikes. But mortgage rates went down quite a bit during that period. So it's not a direct correlation. Mortgage rates are tied to long-term securities. Like, for example, a 30-year fixed rate is tied to the 30-year mortgage bond, which is a long-term investment. The federal funds rate is tied to the overnight offered rate that banks use to lend money to each other, which is an extremely short-term rate. It's literally like a one-day rate. And this has more of an effect on short-term rates like the prime rate, which is something that is adjusted monthly like with your credit cards and things of that nature. So it's got more of a correlation with short-term rates than long-term rates like mortgages. What's more important is what the Fed actually says in their policy statement. So I wanted to touch on a couple things that they said. The first is they hinted at the fact that they may pause on lowering rates here in the short term. And my theory is part of the reason for that is that they want to keep some ammunition in the hopper in case a recession comes here in the coming year or two. Because if they cut all the way down to close to zero or zero, now when the economy is supposedly chugging along, where are they going to go with it? There's some central banks in Europe that have gone actually negative on rates, which is interesting. But the Fed has never gone below zero. We were at zero for a number of years after the Great Recession. And now with it being in the 1.25 to 1.5 range, my theory is they want to keep some ammunition there in case there is a recession so they have something they can do if that happens. So that's the first interesting thing. The second thing is, and this is what had a big effect on mortgage rates, is that they commented that inflation is under control. They look at the PCE inflation report. There's actually two inflation reports, and that's the PCE is tied more to production and businesses and that type of thing. And that rate of inflation is the one the Fed looks at. They want to have their target be that it stays under 2%, and currently it's at 1.7%. So them commenting that inflation is tame or under control had a positive effect for mortgage rates, and mortgage rates improved significantly over the last couple of days because of this, because mortgage rates like low inflation. If inflation's low, it makes mortgage rates go down typically because inflation is the arch enemy of mortgage rates, mortgage bonds. And I've talked about this before, because if you think about it, if inflation gets higher, it erodes the value of a long-term security like a mortgage bond. It makes it so that they need a bigger return over the long term to offset inflation, so that then they can still make a profit after inflation. So the Fed commenting on PCE being under control and being at a low rate, that had a positive effect on mortgage rates. And currently, we're sitting at a better level than we were this time last week. Rates have improved a little bit, anywhere from 1/8 to 1/4%, depending on the loan product. But overall, rates doing very good, and the market's doing well as well, the stock markets. So anyway, that's just a little bit about the Fed meeting. I hope that helps you guys out as you're going into the weekend. If you have any questions about this or anything else loan related, economy related, or your clients have questions, I'm here for you, so just give me a call. Once again, my name is RJ Baxter, Fairway Independent Mortgage. You guys have a great weekend and be safe out there.